Hello and welcome to Future Commerce, the podcast about the next generation of commerce. I'm Brian.
I'm Philip. Today we have, I think probably it's like a little bit of the yin and the yang here with us today. We have a founder turned investor, an investor turned founder, and I cannot take any credit for having come up with that intro. That's entirely Oren's doing. Oren Charnoff from a recently launched new startup called Fondue. Welcome to the show, Oren.
Thanks. Welcome to be here.
And I dare I say legend. Dare I say them
appropriate?
I think legend's appropriate. Legendary founder turned investor Roy Rubin. Welcome to Future Commerce for the first time.
Thank you. Always good to hear your voice, Phil, and glad to be here.
Yeah, thanks. Glad to have you, Brian and I think we owe a lot of our career to the things you've created in this world. So thank you for coming on the show. So today we're gonna dive into a little bit. We do want to get into Fondue a bit. That's what brings us all here. Roy put out this announcement, put out the call on LinkedIn that Fondue had come out of stealth. Oren and I had already traded a little bit of back and forth on Twitter over something that I thought was really interesting. We could probably get into that a little bit, but give us a little bit of the background on Fondue, Oren. What are you solving today?
Sure. So super pumped to be here. It's a really fun group we've got together. So for Fondue, we solve discount addiction for brands. Discounts are the biggest money drain that brands have today. And we replace, for many brands, every discount or coupon code with a more profitable alternative called cashback. It's a post-purchase discount where it gets redeemed post-purchase as opposed to given to everyone, whether they need it or not pre-purchase. And the shopper gets to choose the incentive best for them. To wrap it up quickly, not to be too salesy, brands that work with us simply convert more sales with this discount, about 15% more revenue, but we half discount costs. So this is both a revenue boosting tool, but we're very focused on profitability. So we are here to solve for the biggest addiction no one talks about in e-commerce, discounting and couponing with something better.
Oh, discounting something we've been talking about for a long time.
Yes.
Big fans of what you're doing, Oren. And back in January of 2020, I wrote an article called "If You're Discounting to Keep Customers, You've Already Failed." And I completely agree with you. It is discount is a drug. And so
Brian, it's 55 days to Black Friday, Cyber Monday. This is like probably the wrong audience to try to give your ideologically aligned spiel to.
Well, hold on. Let me and Oren connect for a moment on this. It's like I fundamentally agree with him, and as a long time Costco executive member, I really agree with this strategy.
Yeah, so firstly, we love Costco. They educate the market for us, but also the challenge with discounts is that they work. They really help with conversion. The challenge is you have no idea who actually needed that discount in order to convert. It's a very inefficient allocation of capital. And to your point, Philip, right, it's about to be Black Friday, Cyber Monday. Why do people do discounts? Because they are effective. They're also the best technology to make less profit. So we've got a solution where at this point, hundreds of brands can enjoy having it all, the conversions and the profit. And here we are evangelizing it to the world. But thanks for the opportunity to be here, guys.
We don't often get an opportunity to sort of the early stage of a business to get both the founder and someone who, wrote a check in early. And someone who has had a couple opportunities to help build the foundations of e-commerce, both from the platform perspective and sort of prolifically investing in the apparatus and sort of the third-party growth of the ecosystem of e-commerce. Roy, what is it that you saw in the opportunity in Fondue to come alongside Oren and team?
Look, I think, we try to put ourselves both on the consumer side of things, of course, and also on the merchant side of things when we look at opportunities in commerce. And, here was a real problem, right? We felt like there was, a void in the market and trying to really solve this particular situation. Oren spoke about profitability and obviously, the costs are, continue to go up. Very recently, by the way, I don't know if you guys saw the news in the last couple of weeks, right? But, retailers are overstocked, right? And I think discounting is going to be something that we all see quite extensively, in this new environment, which I think continues to amplify the opportunity for Oren to go and team and go and tackle this. But as an investor, putting ourselves on the consumer side of things as well, how addicted are we as consumers to discounting? Right? It's absolutely crazy. I mean, a lot of the ways that we shop is influenced by our ability to source discounts, right? To source coupons. So we felt that there could be a disruption here. We felt like there was a team here in Oren and Will and the team that they've really brought to the table to really tackle this and try to create a new frontier to really align with merchants and go solve it. This is a strong team, a big opportunity, a space that we can add value to at R Squared, our fund. So it was just a perfect mix of all three things that we like to see when we invest.
I think it's really interesting. You're absolutely right. We saw the news come out recently that there's a lot of overstocking right now. Huge reaction to the out of stock issues we had a couple of years ago, and perhaps a little bit of an overcorrection. It's an odd time for this to be happening, given the inflationary market we're in. We're actually seeing prices rise significantly. At the same time, we're overstocked. We're going to have to discount significantly. What is the ultimate outcome of how this affects the market? Prices rising, but having to get rid of all this excess inventory. How do consumers? I'm curious how both of you feel like consumers are going to be impacted by this, and then Oren, how are you going to navigate this environment that we're in right now?
Yeah. So, Roy, do you want to tackle this first? I'm happy to jump in.
I'll just add one more comment. I spoke to a good friend who runs a lot of manufacturing in China for their D2C brand, and they also manufacture for other brands as well. And container prices now are down to about $3,000 from a high of $20,000. Right? She's getting calls from factories in China that are saying to her, just name your price because we need to keep the production lines going. So this is the perfect storm, right? Retailers are overstocked. They're going to have to move inventory. Not all of them can actually maintain inventory for future seasons. And I think the issue of profitability and the ability to sort of monetize and keep afloat is going to be real. And I think, Oren, I'll let you take it from here, but I think this is, really prime opportunity for them to explore perhaps different models, Fondue being one, that will allow them to create, a higher level of engagement while at the same time keeping, as much of the, of the margin to themselves as possible.
Yeah. So I look at it from the shopper's perspective and then from the brand's perspective. So from the shopper's perspective, people are going to seek value, right? If the economy is just going to get tighter, they want to find value. Like we said, you have value-oriented shoppers exist in many ways. So rather than giving many shoppers a tiny bit of savings with the pre-purchase discount, you can give them the choice of how they want to get these savings post-purchase. Do you want to claim that as cash? Or if you love the brand or you love the best deal, the brand can sweeten it and incentivize you to take a site credit that's worth more than what that cash would be. So if you're seeking value, this actually just gives you more money in the shopper's pocket if they choose. And for the brand, because shoppers get to self-select, do they want the saving and what type of saving do they want at all, you get to efficiently allocate capital, you get to do more of these full price sales, and you don't discount to everyone, meaning for those who don't need it, they simply won't claim it. You got to believe that people who care about savings will do this, and we see that they do. So what I would say is for those who are seeking value, they can get more value with cashback. Because it's more profitable, brands can actually increase the amount of cashback value that they're offering to a shopper, 20% back instead of 10% off. So you can get more shoppers who, because of their demand curve, just wouldn't get there. And then for the brands, it's just strictly more profitable, so they get more value per deal sold as well. So hopefully we found this nice little triangle that we can give it all to those who want it and need it, as opposed to inefficiently allocate to those who don't.
Sorry
need
to step
savings.
on you there.
No, please,
yeah,
please.
I think that there's it's very spiritually aligned with something Brian often talks about, because I think it's a yes and because I don't think it's really a trade-off of channel. I do think that there is a certain type of shopper who will opt into the membership aspect and opt into post-purchase cashback, post-purchase sort of value return, and they see a tremendous value in that. But they're going to shop in other channels too, because that's the world that we live in now. And so I think having differentiated strategies, this has been the challenge of omnichannel for, the better part of 5 or 6 years now, is that we're running the same playbook in every channel, and we're just trying to be omnipresent without really differentiating why that channel exists and how it could align to certain shoppers' values. And so having an opportunity to exist on Amazon with one discounting strategy or one merchandising strategy, and exist in your direct to consumer with a completely different strategy is, I think, a much more holistic way of trying to reach more consumers with more opportunities to align with the way that they want to emotionally connect with your brand. And that I think is what's sort of missing right now, is we sort of have this sort of clone stamp strategy based on channel, and we think of it as channel affinity. And I think it's actually much more nuanced and much deeper than that.
Yeah, I totally agree. And you also have something called like MAP compliance, which is you have to have standard pricing across all your channels. But we actually don't do anything to adjust your pricing. You can sell the same way in multiple places, and just on your site, you give the shoppers, that post-purchase kicker. So it actually enables you to do this compliantly across all your channels as well.
Yeah. Let's shift the conversation a little bit, because I think that there's sort of a bit of a brain trust here. When you're thinking about this moment in e-commerce, Roy, I have to believe that there's a bit of uncertainty on what the next stage of growth looks like for e-commerce. I've heard a lot of people sort of forecasting a pullback. I might be one of those. But I think that there's sort of a natural regression to the mean. We're definitely seeing that happen. But overall, I think a lot of consumers are still looking at digital first from a lot of their purchases. What's your outlook on direct to consumer as sort of a viable growth channel in 2022?
It's really interesting, and I find myself thinking a lot about that. And I don't think I have the answers, because it's challenging times. I think we're seeing macro environments become more difficult. I think we're seeing some of the repercussions coming out of COVID. Obviously, an acceleration, now pull back a bit more. Reverting to the mean, resonates as well, and I think that's what indeed we're seeing. I've always believed that we have an opportunity with online commerce to do more in the experiential side of things, right? Mm-hmm. And create experiences on top of that. Whether that's offline, online, those bridges and those moments of contact, I think are interesting. But you're right. It feels like things are indeed reverting to a mean. They're slowing down a little bit. And as much as I want to tell you that I have the crystal ball and kind of have it all figured out, I'm honestly sitting on the sidelines looking at this as well and trying to figure out what's next, right? I know there's a lot of smart people thinking about it. And we take a lot of those calls and we try to listen in, but I haven't really kind of found that magic bullet quite yet.
Is there is there sort of a style of deal flow that you're seeing these days? Is B2B SaaS as prolific as it was for some of that early stage investment, or what's some of the deal flow that you're seeing today?
So I would say over the last couple of years, I think the growth in Shopify and the app ecosystem, the enablement ecosystem, has led to a lot of companies kind of start and latch on to this tailwind that the Shopify ecosystem has really enabled. We really haven't pulled the trigger on any of these per se. Because what we're looking for is something more broad, right? We're looking for real companies that sort of have a much broader spectrum. Mm-hmm. B2B SaaS, we've seen a few, not a whole lot, to be honest. Headless has been constant sort of area of investment and opportunity, and we've seen quite a few of those over the years, but just haven't pulled the trigger as well. Yeah, I think we see across the board, really interesting models, and companies form. We're just, again, trying to connect the dots and figure out what's right, where the opportunity there is, where we can add value. The most important thing for us as investors is to be value add. That's sort of how we position ourselves. It's hard to pinpoint, what the trend is and what that next growth curve may be.
I do think it's interesting. You said you're not investing in companies that are sort of necessarily built around a specific ecosystem, but are more focused on solving a broader problem. I find
That's
that I find that really interesting. There was a tweet, Philip, that you responded to recently about how, like, innovation. There was a criticism about the old adage that innovation happens in a downturn, and the best companies are
Oh
built
yeah,
in a
Harry
downturn.
Stebbings,
Yes,
who
exactly.
prolific podcaster, nay investor. Right?
And I thought, Philip, your response to that was like really, really interesting. Actually, yes, really, really, incredible companies are built around broad problems, not just around tech ecosystems or specific innovation that happens. And so, Roy, as you've invested in a few of these opportunities, maybe you, like you said, you don't necessarily have the answers, and I think that's really wise, and I think that's it's tough to know what's coming next, but you have made some specific investments. What are some of those broader problems that you've invested in or hoping to solve, that you're really excited about right now?
Yeah, so take Oren's problem, right? So profitability for merchants, right? That is a common theme that we see across the board, right? And that's one example. On the same lines, we also invested in a company called Just that is really helping merchants handle chargebacks in a much more efficient way, right? Also around the theme of profitability, right? So we try to look at these big themes that kind of especially in the commerce space, right? That really we can understand that merchants have a pain point, that we see strong teams that have not only great execution skills but are very data driven, and we have high conviction that these teams can actually put out a great product in the market. That's the first thing that we really look for. Can these teams really execute well and create an experience that is really second to none. By the way, another company that I'd like to mention is a company called they just changed their name, Kenbee. Oren, do you remember what the new company name is?
I thought it was I thought it was still
look
Kenbee.
it up because
I'll do a quick Google for you. Yeah.
No, it was changed, but
Kip.
That's it. So they just changed from Kenbee to Kip. And what Kip does, what Kip does is it helps merchants work with card issuers to approve more transactions. So in cases where there's not sufficient funds, in cases where there's a decline in the credit card, it could be for various reasons. Kip comes in real time and basically says to the issuer on behalf of the merchant, hey, what additional margin do you need to make that risk go away, to approve the transaction that you would have otherwise not approved? So again, in the theme of helping merchants convert more, retain more, reach higher profitability, those are things that I think are top of mind for us, especially on the commerce side. And that's where we like to invest, and again, in strong teams.
There's on the idea of team here. There's been a lot of sort of conversation around remote culture, especially the last couple of years. Once upon a time, Roy, I think building locally in certain regions was a differentiator. I think sort of prolifically being LA tech, or Eastern Europe tech, I think was a way to concentrate talent in a certain place, and sort of plant your flag that this is sort of who we are and where we're located. Times have kind of changed. But I think, Oren, you have a very specific viewpoint on that. You're building your company. It's an American company, but I think you had said pre-show that you feel like building tech in Israel and having a footprint in Israel is a real differentiator for you in the business. Oren, what's your philosophy there?
Yes.
How does remote play into that?
Sure. So any Israeli company's been doing remote for forever. Most Israeli companies are selling to markets outside of Israel because it is a tiny economy. So be it living the lifestyle of, working around the clock or having teams in other locations, i.e. all over the States primarily, working remotely is nothing new. What I will say is, from what I've seen across Israeli tech companies, I'm based out here in Israel. We're legally a U.S. business. I'm American born and raised, an Israeli immigrant, an immigrant to Israel, rather. And what I'd say, I think actually, Roy, you can correct me, but all three companies that you mentioned, Just, Kip, aka Kenby, these are all Israeli tech companies where core of the team is based out here in Israel. The best Israeli, talent want to come into the office still. So you may have sales, marketing, biz dev in the States, but the core of the company is going to be based in Israel generally. And it is the best time to be building e-commerce tools out in Israel. We are in the second generation of e-com infrastructure in Israel, where we have a precedent of first generation massive companies that both have talent that you can, as they graduate and look to start or join something new, or that we see a precedent. You can build a huge business serving brands online, serving the e-commerce and commerce market, is that we have all of that available today. You have companies like Wix, Riskified, Forder, Yotpo, and Globally. Outside of Forder and Yotpo, these are all billion-dollar, mostly publicly traded companies. So now you get that institutional knowledge of e-commerce, understanding how brands, can operate. You have folks who are building tools on top of, Roy's platform, Magento, and now onto Shopify and everywhere else that can talk about what our platform shifts as the big trends in commerce. But also all three companies that Roy mentioned, Fondue sitting in, creating a new discount type, Just focused on chargebacks, and Kip about issuance acceptance. These are all fintech and e-commerce, right? These are huge new categories where you're seeing Israeli founders flocking to. So you want to be building these things in Israel. So that's why my co-founder is based in the States, but I'm out here. I've been here for 5 years. Our business is a year old. You're going to continue to see more and more tools be built in Israel, capable of handling remote teams wherever they are, but the core of the companies will be in Israel, I think. I know that was a long-winded answer, but I'm pretty passionate about this point.
No, it's. I think it's a really astute answer. Roy, you sort of have the reverse story. What you built your company in the United States, I think, having immigrated from Israel. Is that right?
Well, yes, I did, but I immigrated from Israel at a very young age. So I started 5th grade here in the United States, and I spent 3 years in the military in Israel in between. But most of my life has been here in the United States. Back when we started Magento, which really was founded from a consulting firm while I was at UCLA, I started a consulting firm. I'm old enough, Phil and Brian, to remember the days where we didn't call it remote. We just call it, we had to get the job done, and we hired people, to get it done. So it's kind of funny how it's become, obviously a whole new category on its own. But back when we started Magento, it was, Yoav and I, 2 Israelis living in the United States, both having immigrated at certain points in life. I'd say that we had only a very limited number of, Israelis, work for us in Los Angeles. And I think one over the years we hired, in Israel itself, but most of our technology was built by our team sitting in Ukraine, where we felt obviously a very strong connection and bond to. And, we saw them as part of the team. We had 3 offices, in the country. It felt very natural to us. For me, Kiev always felt like Tel Aviv. Honestly, I landed there and felt very comfortable there from the first minute. And it works. I was always a big believer in it as an operator myself. And by the way, I invested in a company back in the day called TaxJar, started by Mark and Ryan. Yep, and Ryan Thompson. Ryan was with us at Magento before leaving to join Mark and spin up TextJar. And at the time that they sold to Stripe, I believe Stripe put up a press release that it was the largest remote company acquisition ever, and TextJar was remote
famously remote from the beginning, right?
That's right, from the beginning. So full circle there, but I've always believed that I never really had a problem with it. I think you do get some scale and advantages by being in the office. It works really well in Israel because the psyche, the DNA is a little bit different. I think once you're in country in Israel, you sort of understand just how powerful being in the same room really is, and I'm sure it's like that abroad of course as well, but there's something magical about that environment, but I'm a big believer in it, and it seemed to work for us and many others.
I mean, correlation is not causation, but Mark at TaxJar, we were the first podcast that he ever sponsored over on Mage Talk. I'm just saying.
Oh, no way.
It's a very successful exit there. I feel like their early growth could be. I shot him an email and I told him as much.
I will spread the word.
Yeah, please.
Folks,
We've hey, we're doing well enough on at Future Commerce. We're growing leaps and bounds. If you're a growth marketer, give us a call. We have our own sort of thesis. We're really about. I think we're very principled and very ideological about the way that brands are built. I don't think that you can do that in a hurry. I know that we have a couple of capital allocators here. I feel like capital is like one part of a smaller part of a lot of things that have to come together, a lot of which is probably just luck and timing, which you don't have a ton of control over. But capital definitely can accelerate some things. But I think really enduring brands grow slowly over time, and it takes a long time. Do you think, Oren, I'll start with you. I've heard a lot about sort of like the cost saving aspect of the thesis and sort of like helping profitability. Do you think the growth era of e-commerce is sort of coming to a slowdown, and now we really need to focus on, how we win over the long term by focusing on sort of profitability and margin and, we've sort of stabilized as a channel now to where the growth is probably we've gotten all the growth we really can. Now it's going to be really slow going over time. Is that the thesis at its core?
Yeah, except for I challenge that and say people want it all. It's not good enough. People don't want trade-offs. People want it all. The marketers are still going to be very growth oriented, and that comes at a conflict with the finance business owner, right? Who isn't. I would say, and Roy can attest to this, but like investors, I think care a heck of a lot more about profitability. Buyers of brands, buyers of, SaaS products care. We hear that was not a word when we started this business that was top of mind, and now it is. So I think like the overall key metric, if you intend to exit a company, will be you have to explicitly address profitability and not just a path towards it. But people want it all. People don't want trade-offs. You will see this conflict now. Oh, you actually can't increase your discount value because it hurts margin too much, as opposed to we're optimizing for, our CAC or some other number that we actually see can be a fairly vanity metric. But I do think that people want it all.
I think it's interesting the type of solution that you have, like the opportunity for growth. I think potentially comes from the working with your existing customers angle, because discounts, it's like you talked about how eventually you have to look at profitability, but also like churn is a huge problem with discounting. So when someone goes in, makes a purchase because of a discount, they may never make another purchase unless it hits that price level again. So how especially there's been a lot of focus on loyalty and retention and growth of existing or customer lifetime value. How is that sort of thinking played into the product as well? And what do you expect Fondue is going to do to CAC?
Yeah.
Not cost of customer acquisition, but customer lifetime value, CLV.
Yeah. So the first thing where it begins is like the initial transaction, which is you say to the shopper, instead of 10% off, you can get 20% back, right? And some shoppers simply don't claim it, and that's and that's totally fine. It means they didn't need the savings. And if you are value oriented and you want to build LTV, it goes to the brand. Instead of giving them $10 back, as cash, how much are you willing to juice up site credit? What we're seeing right now is we are turning 20% of discounts into gift cards, right? That's called LTV right there. It's decreasing the amount that you're paying out on discounts, and you're turning 1 out of 5 discounts into site credit, which again, the brand can specifically market those site credit holders, encouraging them to use it, not needing to tell them a discount because the shopper feels like they have value, or the brand may choose actually not to encourage that shopper to use it, right? It depends what the brand is optimizing for. Is it LTV or is it for margin, right? It's totally up to them. But what we're seeing is this is a great opportunity for those who want the savings, you give more, and for the brand who wants re-engagement, turn a discount into a more valuable site credit.
So what I love about this sort of a solution in the marketplace, and by the way, I'm a big believer in sort of abiding by FTC rules. If this was a sponsored episode, I would have called it out at the beginning. I just like these guys, but I think that there's a really interesting model here in that, like, you don't need a SaaS app to do this. You could roll your own. People do this all day long. Like, you could go out and build this. It'd be significantly harder, for sure. And the operational cost of doing that internally and sort of internalizing that as part of the culture of how you build your business, like, you really can't fail because the things you would have to build to make this work one off, I think, would be a pretty large investment as a team. What I'm concerned about, and I'd love both of your guys' takes on this. What I'm concerned about is that Shopify has turned the modern commerce operator into a consumer, and that they try something, and if they don't see CLV move in Triple Whale within 30 days, they deactivate it. So they're samplers as well. So the business operator is no longer committed to the long-term investment in technology as a differentiator. What they're doing is they're just throwing things at the wall. And it's sort of like it's fashion now. So in fact, Triple Whale's out of fashion now too. Now it's Northbeam. We're just going to move, from one thing to the next because that's what we do. And I think that ease and that lack of barrier to entry of having to invest in technology over the long run makes us really like schizophrenic in the way that we approach strategy and solving an actual problem. Roy, do you agree with that, or?
Yeah, I think discipline is important, right? And I think that in an era, look, we've just had 2-3 years, right? 2+ years of growth at all costs, right? Interest rates were low. The ability to raise capital, was much lower. Companies could simply throw money against the wall and see what works, right? At all costs. And that era is over, right? So we're in a different chapter today than we were the last 2 years, and that is that now merchants and brands are going to have to start to look at the bottom line because they can't fund this this top of funnel growth anymore to the same extent that they've done so over the last 2 years. So now I think we're going to get into an era of higher discipline. I love that you said the schizophrenic by just moving around tools. I totally agree. Right. And, it's got to be sticky. It has, churn has to be low, especially when looking at these tools. If the barrier of entry is too low, that's a problem. The question is, what is the moat? Right. All these things I think resonate, for me as an investor, but I think for a merchant as well is how do you create a disciplined environment without moving around like crazy to try to just test everything? Because once you do that, you just don't have the right data. Right. I think that's the reality. You kind of lose focus. So yeah, no, I totally understand your point, and and it's a good one, and I think that this is an era of discipline.
I would
you said moat, and I'm triggered now. So many people are building moats these days; they've never built a castle in their life. You have to have something to actually protect before you actually go out and try to protect it, and that's the problem. I think at its core. Oren, you were going to say something. Sorry,
I was going to say a few things. The first one is. That Shopify's created an incredibly efficient market for both tools and for brand operators to discover new tools and to use and to measure them quickly. That is a good thing. That's number one. I think number two, Shopify to me represents two things. The first is it's an incredible laboratory to measure net impact a product can have per brand. the level of effort to go live on any other e-com platform, be it a home-built one or the Salesforces, the Magentos of the world, it's a fair amount of work, and you need a developer involved generally to do that. And so actually the bar of level of effort is quite high. So the expectation of net impact is really high. So Shopify is great because it's a sufficient market where discovery is fast. It could be schizophrenic, fine, but you do get that test nonetheless. You can measure the net impact per brand, and then you can make a business decision. Where do I go to market? And Shopify is probably amongst, if not the most important go-to-market. But then you can decide if the net impact is high enough. Do I have Shopify product market fit or e-commerce product market fit? Because you could add an app, and I don't want to diminish what these tools are to apps, but these tools may add a couple of basis points each. And what's beautiful about Shopify as a brand operator is you could add 20 apps that collectively add a lot because it's so easy. But to go onto another platform, you can take the laboratory of Shopify and say, we add this much margin for a brand, right? Or Fondue, we decreased discount cost 50%, and we did it for these hundreds of brands. Here's why you should put in that increased level of effort elsewhere. It is hard to find a guinea pig when they have to do a lot of work. Shopify is the efficiency of their market, enables everyone to test in an effective way for all of e-commerce. And if you don't do well enough, you will be stuck, addicted in the Shopify ecosystem to the schizophrenic type of operators, perhaps. But you could still build a fine business doing that, but not necessarily a category business.
I do wonder. So we've been in the D2C era for a while now. This is a few years now that we've seen this huge momentum towards this, and it actually has a lot to do with what you were just talking about, Oren, where there was the opportunity to go to market so quickly and efficiently. What we are seeing now is some winners and losers actually kind of start to pop up out of this. And as you see some of these D2C businesses, and I'd love to get actually, feel free to hop in and react to this, any of the three of you, because Philip, I've not floated this idea to you yet either. But as these businesses start to mature out, the person that was, that founded them, or maybe a couple of the operators, they had to pick tools that were naturally easy to work with because they were doing so many jobs that they didn't necessarily have specificity of role. And as they've
maturity,
grown up, exactly. So as they've grown and become more mature in their business, perhaps right now, actually, what we're seeing is a little bit of a tipping point where the people who originally ran the business are actually coming up against a skills wall. And they're having to specialize now and take the next step in their business and make investments to your point in things that you can't get schizophrenic about. You can't jump around on. You actually have to make an investment because it becomes a career unto itself. And so I wonder if we're seeing right now just a maturity of something that started a few years back, and now their tool set has to shift and the roles have to get more specific.
Well, let me jump in here because I think I have a way to bridge it over to Roy. I think one of the chief's criticisms, not to adjudicate Magento 10 years hence, but one of the chief criticisms of Magento was or has been that people bought into the ecosystem who weren't ready to run custom software in dedicated hosting environments. And so they bought into something that was sort of above their pay grade. Now, I know I've been part of a lot of growth stories in Magento. A lot of them grew into it, right? I think a lot of people realized, that they kind of maybe bit off more they could chew as well. Is there an operational map to maturity on software, and is that why we have so much stratification of software these days, Roy? Do you believe in that?
So, so let's map this back now 10 years, right? And so, Magento came on the scene in a pre-cloud world where existing tool sets were largely either open source or enterprise commercial, right? There was nothing really strong in the middle, right? And this was an era that, I think merchants ultimately wanted differentiation. There weren't any SaaS platforms around that could give them, I think, an all-in-one box that could simplify their life. And I think it came at a price point of open source and free that allowed them to have access to really great software, with very low friction. Right. So at the time it was, the right product, which ultimately led to a great ecosystem and community. And I think helped sort of, a lot of the merchant base that was using the product kind of elevate. Shopify comes around, simplifies that, or SaaS platforms like, but Shopify, of course, being the lead, they come around and they say, you know what, none of this headache that the merchants really had to go through as far as infrastructure and security and upgrades, et cetera, are things that really are critical to their core. We're going to commoditize that, and we're going to be able to provide them value add layers of apps on top of it so they can really focus their time and on infrastructure things, but on applications, right? On ways to create more conversion, retention, acquisition, et cetera, which makes total sense. Now, the last couple of years, headless folks came around and said, "Hey, we think now the front end needs to have a lot more flexibility. We want to create experiences that are faster, that have more functionality, that are able to stand out, that create differentiated abilities from all the rest, because a templatized, if you will, quote unquote, system can only give us that much of an edge, right? We're sort of constrained in the way that the front end works." So, I see this as kind of cyclical, right? You look at Magento, a lot of work to do up front, heavy lifting, a lot of maintenance issues as far as infrastructure and access to developers and resources. Shopify probably has taken that down. Well, not probably, it's taken that down significantly, right? From an overhead perspective. Headless now, we're back to some version of that, depending on the platform. The question is, what is next? I actually, this goes back to the first question you guys asked, which is, what does the future look like? And I've long advocated for, how does a data-driven commerce product, we're using a lot of data, right, across all the different layers, right? We're making decisions based on data. Well, how much of that can actually power the e-commerce experience from end to end, right? And I think these next evolution of commerce products will take a lot of the decisions as far as what apps to use, what converts. Instead of us being schizophrenic and trying to move around and select the apps that are actually going to materially make a difference, well, what if systems now through AI and other technologies can help us figure out what the right combination is based on the underlying data sets that exist? So while I started and said I don't have a crystal ball, I'll tell you what I do know. I do know that data will be a big part of how we make our future decisions, right? And that's going to translate across the board to how we serve our customers, to what technologies we use, to how to continue to optimize. Those are all things that I think are going to be meaningful. So I'll pause there, but I wonder if that even answered your question.
and I'm sure that there's someone out there who's screaming why we would use the M word on this show so many years later, when you've certainly gone on to another prolific stage of your career. I think it's worth noting in that the times they are a changing, and we're in a different phase. We're now 2 generations removed from what e-commerce was in, say, 08, 09. To where we are today. Right. And that's where I think that you have this idea of an ecosystem all trying to gain some sort of maturity together is, I think, is inherently fascinating. I think at its core, and Oren, I'll give you the last word. At its core, we're measuring things that we call lifetime value, CLV, customer lifetime value. I'm sorry, but like a customer lifetime should be longer than 90 to 180 days. So the window by which we measure that sort of attribution is like already like wrong in name, at least, but potentially flawed fundamentally in that the rate of return or the expected horizon of return is so much shorter than what I think a customer considers their like relationship with the brand to be. On a longer time scale. Last word, Oren. What do you think?
Everyone's a little bit down on like what the market looks like. I think like if you're like an early stage founder, be it of a brand or be it of a software for brands, like you really don't care about the macroeconomic condition. That just speaks to short and medium term valuations. And that is hopefully fleeting in the scheme of things. I think like what Roy can attest to is like Magento was bought and sold a few times, and it was a great outcome constantly because they had a really, really big vision. And R Squared, Roy's fund, will invest in companies really all over. They just have special access to deals in Israel, but they invest also in the States. And it's not often that if you're building something in commerce that you can have a founder of a leading platform, Magento, and also a founder of a leading e-gifting business, which was sold to Roy's partner, whose name is also Roy, they're great folks to connect with. And the internet is an amazing place where Phil and we just met online on Twitter, and he wound up doing a podcast on something that I suggested. And Phil introduced me to Brian, and we're totally going to do business with Future Commerce. It is such an awesome time to be building things in commerce right now that like there's a ton to be pumped about. It's just mostly talking about short and medium term valuations.
Yeah, and we got to get through the near term to get to the this dreamy dreamscape future. Insert the image. This could be us if we all knew how to pronounce Chipotle. But if this would be us if we all understood how to build equitable and sustainable businesses. Hopefully, with tools like Fondue and with investors like R Squared. What an awesome time! Highlight of my year. What a way to kick off Q4. Awesome. Thank you so much. Thank you guys for joining us on the show.
Thanks.
Thank you.
Best of luck.
Thank you, Brian. Thank you, Phil. Yeah. Really appreciate it.